Hi, it's Larry Gaines, and I wanted to show you a trade setup that we spotted today. We were doing our Q&A, and one trade that looks pretty interesting is AMBA. So if you look here at AMBA, this is what we call in a daily squeeze. You can see that it's kind of consolidated down here towards these lows, 33.96. Now, when it starts to enter into a squeeze, there's potential for a big pop to the upside or downside. So the next question is, well, which direction? So we look at our momentum indicators, cycle 1 and 2, and so they're above 0, shows that the probability for this to trigger or break out is to the upside. So a couple different trade opportunities here. So the next thing I do is put up my targets based on Fibonacci. So 382 comes in right here about 42.79, and then 45.65, and then 618 up here close to 50. So with this particular trade, a couple things to do. You can also see on the 78-minute time frame, nice solid momentum. Break it down to the hourly time frame, nice momentum, and 30-minute time frame, momentum is still to the upside. So if it'll come up here in a second. So the trade setup that I did was based on the implied volatility being very high. I like to do a bull put credit spread to collect premium. So you can see AMBA here currently trading close to about $42. So I'm going to put together a bull put credit spread at the money to slightly in the money and get a positive risk ratio. So if you look at the option statistics for AMBA, you can see that the current implied volatility percentile is over almost 80%, 78%. So that's very high implied volatility, which when I see situations like this, then I want to sell premium and collect premium. So I'll show you the trade setup. So for this trade, going to kind of at the money, 41.88. So I'm going to sell the 42 put by the 41, just a dollar wide spread, and collect 50 to 55 cents credit. So when you look at that trade, you have potential upside of profit of 55, max at risk $45. So it's better than a 1-to-1 ratio. So I like that about it. Low capital cost. All you have to put up is that margin of $45. So the trade is the 42.41 bull put credit spread. Short the 42 strike, long the 41, $55 credit. Max at risk would be $45. That's your capital you put up for the margin. You can see it's got a positive theta, so time decay goes in your favor. And you've got a potential at expiration, if it expires, over your 42 short strike, you make a total of $55. If it doesn't, you're still going to get theta decay to give you potential decent profit anyway. So nice trade setup. I like these type of credit spread situations in a highly volatile market with high volatility.